So welcome to the webinar. Today we're going to discuss a very important topic for all investors, which is how to value stocks. Now, there is no one right answer to this question. Obviously, with the complex investment world, people have various strategies and various different calibers of stocks they are trying to value. What we're going to do today is kind of take a value investor's approach and show you the majority of the most commonly used methods to value stocks. These are also going to be built into the Guru Focus website, and I'll kind of show you how these models are done for you and how you can use them for various types of stocks. So we're looking at here, anytime you go to a particular stock on the Guru Focus webpage, at the very top of that page, you'll see this, and it doesn't matter if it's a penny stock or a mega cap like Apple here. A couple of things are going to pop out at you. Obviously, it's going to show you the business predictability ranking here with the stars. It's going to be an out of 5 stars measurement. It has any warning signs that are automatically generated based on our algorithms, and you can click those to see what those are. And then right over here are the standard valuation metrics, and it's kind of interesting the way this is laid out. So it shows you each one of these by title, and then gives you these colored bars over here to the right with this green dotted line. And what this is going to do is, if this valuation method gives a price that exceeds the current price of the stock, it'll be over here on the right side, as we see with the Peter Lynch value. So what this is doing is giving you a green dotted line at the current price. It's kind of in a histogram format, and then these colored bars showing you what that valuation projection. So obviously, tangible book value here on Apple is far less than its currently trading price, but the Peter Lynch value is in excess. So this is not an end-all be-all, but from a general point of view, and just a quick reference point, the more of these you have to the right side of this green dotted line, the more undervalued the stock is likely to be. So really quickly, I mean, we're talking about stocks. There are various not only sizes of stocks, but different types of stocks depending on what type of investor you are and what your goal is for that investment, okay? And so some of you are going to be specialists in one area and others may choose a different, but it's important to know what type of stock you're trying to buy and what you're trying to achieve with that investment to determine what the best way to value it is. So basically kind of 3 classes of stocks, if you want to think about it this way. The first are just kind of the old school, Benjamin Graham, what Buffett started doing back in the 50s and 60s, the old Walter Schloss stuff, just kind of these cigar butt type investments. These are kind of nets or asset plays. And essentially all they were trying to do is buy stocks that were trading at a price less than what they could be liquidated for. Okay, so a company's worth, let's say, $1 million on paper, and you can buy the whole company on the stock market for $500 million. That's almost a sure thing unless they just start blowing through money, right? These type of opportunities are few and far between today, but some of them do exist. They're generally in the small cap market. Now the next is kind of the bread and butter of most 401ks and longer term portfolios, and that's your mature, stable companies. This is your Procter & Gamble. This is your Disney. This is your 3M. These are blue chip Dow type of companies, okay? So investment goal with these generally is kind of some steady long-term returns. You want a company that's outpacing the market, hopefully, right? You want a decent value considering what this company is able to achieve, but you're not trying to make 500% on it. All right, and you're also not looking to flip it out 3 months later. Now, we want to find these stocks when the prices present a value compared to their historical valuation, but again, this is pretty straightforward stuff. And then the last caliber is growth stocks, and this is, in my experience, where a lot of people lose the most money. And that's not because you lose money every time you invest in growth stocks, but it's because people who don't know anything about the stock market tend to just think, oh, this company's growing, I want to buy it. Okay, and that may be the case, but if you buy a growing company and you're paying 200, 300, 400 times its earnings or earnings estimates, that's a great way to lose money. And that's what happened in the dot-com bubble of 99. It's a little bit of what happened kind of in '08, but every Great Depression generally comes from people overvaluing these types of stocks. Now, there's a lot of money to be made in these stocks as well because they are growing at such a fast rate. We just have to learn how to value them in a method that's not going to allow us to drastically overpay. Okay, so let's go ahead and get started with the different valuation methods. So here's what we're going to cover. We're going to cover everything that the website shows next to those top stocks and two more. Okay, so it's going to be the earnings power value, net current asset value, tangible book, projected free cash flow, median price per sales value, the Graham number. Then also going to show you the Peter Lynch value and the Donald Yackman Ford rate of return, as well as discount cash flow as well. So let's go ahead and dig through these. We'll begin with the first one on the list, which is earnings power value. This is not one I've used a lot of personally, but I'll show you how it's calculated. What they do is they take the average earnings of the company, so they kind of normalize out what this company generally earns, and they subtract the maintenance CapEx. And CapEx, if you're not familiar, stands for capital expenditures. Basically, what does it cost this company to run? So the reason they separate maintenance CapEx is they want to see what it's going to cost to service this company, right? If we're looking at a printing company, what does it cost to service, maintain the printers, keep the lights on, that kind of thing? Not what are you spending to expand and acquire another business, just what does it cost you to operate your company. That's divided by the weighted average cost of capital. Okay, and this is kind of a figure we use to determine like the minimum rate we're willing to accept on money. For this calculation, it will generally use 9%. And then add in the cash the company has on hand and subtract the debt from that. So this method was popularized by a money manager by the name of Bruce Greenwald. He's one of the professors at Columbia Business School. Great pedigree. It's a little more complex, right? So what this does is it values, it's kind of old school, and it values a stock based on the current free cash flow, does not take into account future projections, because in his mind they may or may not come true, right? So it's generally not great for growth stocks. It's not factoring that growth in. It's just looking at the more stable, consistent companies with little growth, trying to value their current cash flow going forward. So the last thing, it makes an assumption that their current profitability will sustain. So you hear people use the word value traps, and that's generally they're using an equation like this, thinking what the value of the company's worth, but what they didn't do is enough due diligence to realize their earnings may suffer going forward, or they're in an industry that's dying, or they're no longer the front runner in their sector, that kind of a thing. And as we mentioned, does not take into account any future growth. So the next one is net current asset value. And this is a very old school approach, again, used a lot by Graham and Buffett. Here's the formula for that. And what it looks at is essentially just trying to get kind of a liquidation value of that firm, right? So when you get a company you can buy at less than net current asset value, I would argue that that's as close to a sure thing as you can find in the stock market. All right, now, assuming, again, there are outliers, right? There is a BlackBerry which could all of a sudden have $1 billion write-down in one quarter and wipe out a lot of that cash or a lot of those inventories they had. But for a company who's not just completely lost their mind and throwing money in the gutter, net current asset value is kind of a minimum here. So again, it's used primarily for these nets and these asset plays. One I did was Emerson Radio, MSN, a couple of years ago. It was a very quick calculation. You could have done it on a napkin. Came out to be worth about $2 a share, or was it $2.20 a share? The thing was trading at about $1.50. Not a huge return, but it was a 50% almost sure thing bet. Now, again, it does not give value to earnings or growth like the others, okay? So this is not one you're going to try to use to value Apple or Google or any growing firm. It's just for those kind of special opportunities. But this is the primary strategy, as simple as it looks, used by Benjamin Graham. Benjamin Graham being the mentor of Warren Buffett. When he began investing back in the 20s and 30s and 40s, we didn't have internet. People didn't have access to all this information. So it was very common to find these stocks with a net current asset value of, say, $10 million, and they're trading at $2 million. And it's almost an impossible way to lose money doing that. Now, modern technology and all the information we have available to us and arbitrage players have taken a lot of these opportunities out, but there are still some in the small cap market. Excuse me. Another simple method, very along the same lines as net current asset value, is tangible book. And it's just as simple as it sounds. Just the book value of the company, aka the net worth, right? What do they own? What is their property, plant, and equipment worth? How much cash do they have? How much, raw steel or finished product they have out there, minus everything they owe to creditors or accounts payable, anything like that. And then you subtract the intangible assets. So intangible assets, anything you can't touch or feel, right? So that's going to be a patent. That's going to be a copyright. That's going to be a trademark. For instance, if you look at Coca-Cola and you're valuing that company, what do you value the Coca-Cola name or that logo that's known all over the world? Well, that's an intangible asset. So for the purposes of this formula, it's just looking at what's on the books, right? So again, even simpler than NCAV. Once again, no value to earnings, no value to growth, values the stock solely on the assets that it is holding. Now, here is what I would consider the most commonly used valuation formula, and the one that there's some great tools out to use here on the website. This is the discounted cash flow method, or DCF. And you'll hear this a lot if you're reading a lot of the great articles here on Guru Focus. If you're reading, quarterly reports on these large value-minded gurus who manage billions and billions of dollars, they'll throw this term out there. And what it is essentially is an attempt to figure how much money this company is going to produce, cash, true cash flow to the shareholders over the next 20 years, and then what are those figures worth to us today? Okay, so if a company is going to make $100, then $120, then $150, then $180, and you add all these up and say it's $2,000, and then you discount those figures back to present day, right? Present. The value of $100 today is much greater than $100 a year from now, right? So we're discount all those back and then produce a figure to what we think this stock is worth. So this is the DCF calculator on the Guru Focus website. We'll work through this in just a moment. And this is a look at Apple. Now, by default, the calculator is going to take some inputs into it from the 10-year financials and from a couple of algorithms that are built in there. For instance, the growth rate on Apple, if you were to look at it, I believe showed it about 20% because that was the average of the last couple of years. I toned it down a little bit. A couple things to remember with this. One is garbage in, garbage out. Right? I mean, it's a fancy calculation. You can essentially tweak these numbers to make it look like a great buy or a terrible buy. So don't just go cutting up, trying to tweak this to make it fit your investment objective. You want to use, in my opinion, conservative but realistic expectations going forward. So here's how it works. Here's the inputs. Earnings per share, that's pretty self-explanatory, right? I mean, it's just what do they earn per share the last 12 months. Now, if it's an erratic company, let's say they earned $2 a share this year, $5 the year before, 50 cents the year before that. It's going to be a little tougher, so you're going to want to kind of normalize those and come up with a realistic figure you think they can average, right? The next is the growth rate, and this is broken down into two parts. So we look for a growth rate over the next 10 years, and then what they call a terminal growth rate, or what can it grow in years 11 through 20. All right, so where does this figure come from? Well, this is going to be based off of what the company's been growing the last several years, but obviously no company can maintain a pace of extremely high growth forever, right? There's stages of a company. It goes through a startup, and then it's kind of a boom, hot stock, then it becomes a mature company, and they slow down that growth. I mean, you can't take a $500 billion company and grow it 20% a year every year exponentially. It just can't happen. So you put in an estimated growth rate for the next 10 years, a terminal growth rate for the following 10 by default is going to be 4%, right? Roughly keeping pace keeping pace with the economy. And then you apply a discount rate, and the discount rate is just what percentage it's going to discount those values back each and every year. Okay, so here's how this works. Here's how to think about a discount rate. If I were to promise you $100 cash 1 year from today, what would you pay me for those funds right now? How much money would you give me if I promised you 100 at the end of a year? Okay, so if you said around $88 is a 12% discount rate, around $90 is a 10% discount rate. It's the minimum return you're willing to accept on your money. And this changing this percentage will drastically affect this fair value. Now, by default, I think Buffett uses something like the 30-year Treasury note plus a few percent. This website is going to default to 12, which is extremely aggressive, meaning you're going to get lower fair values for the stocks. It's going to keep you on the conservative side. I've read from the gurus out there, the big names in this industry, using anywhere from about 8 to 12% to give you an idea. And in fact, yes, this can be used on penny stocks. This can be used on mid cap, large cap, you name it. It's what you have reliable enough data predictions on. And then finally, it's going to fair value on the right side. Okay. In addition, we're going to evaluate on paper. If you check this box, what it will do is add. This is just a screenshot. If you check this box, add fair value, it's going to add the $20 to this and give you a value that's about 165 change. Whether you decide to do this, if you get a conservative side, you may just choose to leave it out. Finally, it's going to give you a margin of safety. So what is a margin of safety? We'll show you how much today's price is below your estimate value. So the greater the margin of safety, the better. If it's a red number here and it's negative, then today's price is in excess of your calculated fair value. So let me give you kind of a visual. Maybe this will, for anyone not as familiar with discount cash flow, this might make it a little bit clearer in a visual sense. This is just a hypothetical. I'll just drag this chart from Investopedia, but this is just a hypothetical company, and these are the projected earnings going forward, expenses, and then at the end produces these estimates of free cash flow, right? It's what we're after as investors, especially value investors. You want that free cash flow. What is available to me as an owner of the company? So we've got projections of how much money it's going to make going forward. But $21,000 or $20 million 5 years from now is not worth $21 million to me today. So what we do is apply a discount rate. In this case, I use 9% to give you an example. And when you apply the discount rate, here's what happens. You get the present value of those future earnings that's correlated to each of these figures above. So $16,000 this year is worth $16,000. $20,000 5 years now, for my investment, it's worth a little under $14,000. So just wanted you to kind of see what this is trying to achieve, and then it's essentially adding all these up, going out the next 20 years, dividing by the number of shares that are outstanding, and computing a value to what that stock should be is worth to you today. Does that make sense to everybody? Okay. Let's move forward. We'll come back and do some of those live. If you want to look at discount cash flow a minute, I'll show you the calculator kind of in more depth that you have access to on the Guru Focus side. And just to answer your question, I did see a question on here asking, where these figures come from. Yes, the numbers can be trusted in the sense that they are direct from the Securities and Exchange Commission reports or company filings with the SEC. So unless the company is completely cooking the books, which I would have no way of knowing, yes, these are legitimate numbers. Let's look at projected free cash flow. This is very similar to discount cash flow. It's just designed for more erratic companies. So here's what it does. The formula is it uses a growth multiple for that company, multiplied by the free cash flow, that adds in the majority of the total equity. Okay, so the growth multiple is a formula. It's a combination of EBITDA before interest, taxes, depreciation, and amortization, revenue, and earnings per share. Growth calculates all those growth figures and produces this growth multiple average out. Free cash flow averages the free cash flow over the last 6 years, and it adds on 80% of total equity of this firm just to kind of account for the overstated book value. It's kind of a rule of thumb. Use about 80% because they're going to inflate their value a little bit in a situation. So this is just designed really for companies that have inconsistent revenue. If you do the discount cash flow on a company we just talked about that has 10 million one year, 100 million the next, and 20 million, then they have a $5 million loss. They're kind of all over the map. What this does is kind of average out the free cash flow, put together a growth multiple that's kind of a combination of earnings, revenue, and EBITDA. Try to get a rough estimate that's going to be a little more accurate than starting with either really high year or really low year. Yes, this 9% discount is compounded. Yes, it's compounded discount rate. Now, the next one you're going to see on the website is the median price to sales value. And very simply put, total annual sales of the company divided by shares outstanding times the 10-year median price of sales. What does this mean? Well, I mean, it looks more complicated than it is. This is just revenue per share. Okay, total sales, how many shares are there? Revenue per share. For every share of stock that I buy, how much revenue is attached to that? And then, what generally price to sales figure does this company trade at, right? Is it an industry leader? Is it kind of a laggard? Do they generally trade at 3 times price to sales? They generally trade at 1.5 times. It takes the 10-year median. So you got a full business cycle there. You're kind of getting where they average out and multiplies by the rev per share to give you a projected value based on this metric. Now, this works best for kind of your stable retail stocks, right? It's once again, you're not seeing anything about growth rates in here. It's not forecasting the future. But if you've got a rock steady retailer, you're looking at, let's say like a Walmart type company that grows very slowly, or another retailer that's not on the fast track to growth, great formula to plug into it. Again, it's going to depend on their historic valuation levels, right? So you want to check the median, see how wide that range is to be sure you're not just kind of throwing a dart in the air. And again, it doesn't take doesn't take growth into account, as we mentioned. Now, with any of these valuation models, that initial chart I showed you, the bars that go horizontally to show you where this valuation puts it relative to its current stock price, you can click each one of those bars and it will take you to a far more detailed explanation of each of these valuation methods, and we'll look at that in just a moment. Now, another one you're going to see here is the Graham number. Now, this is, of course, referring to Benjamin Graham, known as the godfather of value investing. Here is his formula. It's pretty straightforward once I explain it to you, while we have a square root and a random number in there. But it's a square root of 22.5 times the tangible book value per share times the earnings per share, right? What do they have? What are they earning? 22.5, give me the square root. Now, why does it do this? Well, Benjamin Graham believed that, and again, this is, take this with a grain of salt, because as brilliant as this man was, he invested in a very different time than we do. So don't be surprised if you plug some stocks into his old formulas and you're not finding a lot of great opportunities. He was just able to buy at deeper discount prices 70 years ago. But his belief was you shouldn't pay more than 15 times earnings per share, or he used the 3-year average because they just weren't growing that fast. So 15 times earnings, and he didn't believe in paying more than 1.5 times book value. What's 1.5 times 15? That's your 22.5. So he kind of had created this formula that say, well, I'm willing to pay, let's say, 20 times earnings per share if I'm getting it for a low book value multiple, right? So I'll take this 15 up to 20 if this is down to maybe 1. Or I'll pay twice book value if I'm getting it for maybe 8 times earnings or 10 times earnings. So what this does, it allows the product of these two, the earnings per share and the book value per share, multiplied and then square rooted out. So you're getting one that combined fits inside of his metrics between these two, if that makes sense. I don't know that I explained that very well, but I think you kind of get the gist of it. Now, the downsides of this, well, one, it's tough to find stocks that fall into these metrics, at least large industry-leading companies that you want to own. Second, it's not for growth stocks. It's going to underestimate them. It doesn't give any value to growth, and it also punishes low book value stocks, right? Some industries are just prone to have more assets on the books and to trade at lower multiples, right? If you're looking at, U.S. Steel, they have to have a lot of inventory. They have to have a lot of machinery. If you're looking at a railroad company, something like that that is, resource intensive, they're going to have a higher book value or trade at a lower price to book multiple. When you look at, say, Google, they don't have freight trains. They don't have steel mills, right? They've got a bunch of really smart guys behind computers. So the majority of their assets are intangible for the most part. So it's probably not going to fit the grand number formula because one, I know it trades at more than 22 times at 15 times earnings and trades well in excess of 1.5 times book. But again, this is for a different time. It's for very simple, stable, salt of the earth type companies. Now, those are all the ones listed on the top of our stock headings. And again, we'll go back. I'll show you some more details in just a moment as we do this interactively and live. But there's two more values that are listed in the 10-year financials. Okay, so if you go to a stock, go to the 10-year financials, you're going to see, the income statement, the balance sheet. You're going to look at all the facts and figures. And down toward the bottom, there's some ratios done through Guru Focus, and two of them are these values. So here's the Peter Lynch value. Very simple. 5-year EBITDA growth rate times earnings per share. So basically, growth times earnings. Right? We use EBITDA, it's more consistent. We use a 5-year average to kind of normalize what kind of rate this company is growing at. And the reason for this formula is very simple. Peter Lynch believes, and if you read his book, One Up on Wall Street, I'd highly encourage you to do that, believe that the price to earnings multiple, the PE ratio, should be less than the growth rate. And that was a lot. That was half of the mathematics he did to find stocks to buy. Okay, so if he had a stock growing at 10%, he didn't want to pay more than 10 times earnings. If it's growing at 20% a year, he'd pay up to 20 times earnings. Literally that simple. And what this equates to is a PEG ratio of less than 1. So PEG, if you're not familiar, is just PE over the growth, right? So if a stock has a PEG ratio of less than 1, then it meets the Lynch test. It's got an earnings multiple less than its growth. If it's greater than 1, it fails the Lynch test. And what this does, it just kind of gives a conservative, and I would say very conservative value estimate for growth stocks, right? If you go through the market and you look at the fast growers right now, if you look at Salesforce for the acquisition, you look at some of the others out there that have been growing at very fast rates, a lot of the social media type companies, they're going to be trading at earnings multiples much higher than their growth rate. And sometimes a company, especially a new startup company, may grow 300% one year, but then we know it's going to slow to 60% or 40% or 20% going forward. So it kind of becomes a common sense battle, and you've kind of got to do some off-the-hip calculations and estimates based on what do you think they can grow, what kind of growth rate can they maintain. And this is why you see wild fluctuations in these really fast-growing stocks, because a company that made $1 a share, and it's a relatively small company, next year did, or your next quarter maybe did $1.50 in just the next quarter. People think, okay, this thing's growing at, let's do the math, 600% a year, so it's worth an infinite number of times of earnings, and the stock quadruples overnight, right? So it becomes sort of this balancing act as the street tries to wrap their arms around what is this company really going to grow, what is a reasonable rate this company can grow at, where is it going to peak out, and what is a reasonable multiple for the earnings we're expecting. So growth stocks are just tougher to value, and there's a reason there's a lot of money to be made and lost in them. And again, you can click the bar in the valuation box for more details on this one. And finally, this one is the Donald Yackman forward rate of return. I don't know if it's Yackman or Yackman. I always call him Yackman. It's found at the bottom of 10-year financials. Now, Mr. Yackman runs about I think it's $22 billion fund out of Austin, Texas. Extremely intelligent investor, very value oriented, does a lot of blue chips. I think his largest 3 holdings right now are PepsiCo, Coca-Cola, and Procter & Gamble. So very fundamentalist type guy. And he's got an interesting approach, and I really like this because it's a different take on valuation. It looks for a rate. So what he's producing is not a value on this dollar amount's what the stock worth, right? He's not going to say it's worth $21 a share, but he produces a forward rate of return. What kind of rate can he make on this money? And his formula is just this. He figures the normalized free cash flow divided by price, and then adds in the growth rate. Okay, so the normalized free cash flow the last 7 years, right? What have they done the last 7 years? Let's add them up, divide by 7, kind of get a normalized rate. If it's a company that's grown a lot, you might want to look at the last few years of a company that's declined in recent years. You want to look kind of in the middle. gets a normalized free cash flow, that's per share, and then divides by that share price. So just to give you an example, I'll show you this in a second. And then the growth rate is just the total revenue growth, right? How fast is this company growing? They did, 100 million in sales, they did 110 million, they did 121 million. That's a company growing at about 10% a year. So here's a very elementary example for you. Let's say you've got a company that's producing on average about $5 a share in free cash flow. They're trading at $100. So 5 divided by 100 is equal to what? 5%, right? 0.05. 5% plus this company's revenue is growing at about 4% a year. So you add that 4% and we get a 9% forward rate of return. So very, very simple. All it's trying to do is say, hey, what are they earning? What is my share earning on it? Right, depending on what I pay for it, how much free cash flow am I getting for that? And then I'm going to add on the growth. So I'm going to figure, hey, they're earning 5% of my money, plus they're growing the company at 4% a year. This is about a 9% rate of return on my money, which is just slightly in excess of the average for the S&P 500 over a 10, 20, 30-year basis. And so you've got one stock, you get a forward rate of return of 5%, one at 15%. The decision is very easy. So it's a different way of looking at it. You can kind of get away from, okay, it's worth 150, it's trading at 120, I want to buy it here, then I got to revalue, or should I let it run, or am I hoping to get, PE expansion, or that kind of thing. It gets you away from price a little bit and gets your mind focused on what is this company going to earn for me, right? Because if you own the business, you're not looking at, okay, I bought this business for $300,000. What is it worth next quarter? What is it worth next year? No, you're looking at what kind of return am I getting on my $300,000 investment. So this is very, if that's kind of how your mind works, is a really nice tool. Again, it's in the 10-year financials. So we've covered these valuation methods listed here at the top, and we've even included the Peter Lynch value and the Donald Yachman forward rate of return found in the 10-year financials. Now, what I'd like to do now is go live to the website and kind of work through some of this less theoretical and a little bit more hands-on. Okay, so let's take a look at this really quickly. We go to the Guru Focus site, and let me blow this up so you guys can see it. I'm going to zoom in on the screen. And this is the Apple example we looked at, right? These are those over here on the right side. These are those valuation metrics. And as I mentioned, you can click on each of these colored bars. Don't try to click on the title. Click on the colored bar. I want to show you what that does. We'll click on the gram number, for instance, right here in blue. And notice if you hover over it, notice right above these colored bars, it gives you the exact dollar number, 6163 in this case. So if we click this, it will take us to a much more in-depth summary of this gram number. And it's going to show you, the 10-year price to gram number range. It's going to show you where it is ranked in its industry of global consumer electronics. It's going to show you comparisons of its largest competitors. It's going to show you a historical chart of what this gram number has been. In addition, it's got the exact formulas for each of these. So it shows you where it comes from, what the exact figures are used in the calculation. It'll give you a text explanation in layman's terms of this formula and why it is used. It also, some of these have a couple of risks in here just to kind of educate you on this particular valuation method, what the risks are and what the downsides are. And then it shows you the historical data. So really, really neat. I like the way that Charlie linked this up. As you notice down the left side, this is the full fundamental dictionary, and you can find just about anything regarding stocks and valuations in that. So that's one interesting thing, right? And that works for any of these. It works for earnings power. It works for the Peter Lynch value. It works for any of them. They're all going to take you to a very similar page that explains, shows the history and the relative valuation of this stock, this valuation method compared to itself, its history, and the industry as a whole. Now, The other thing I wanted to show you is where these others are in the 10-year financials. So when you go to the 10-year financials, obviously it's a lot of data. We know this. We know what to dig through, what we're looking for. But when you scroll way down below the balance sheet and below the cash flow statement, you see this section called valuation and quality. And this is where the Peter Lynch value and the Graham number and even the Donald Yackman rate of return, I think it's a little bit lower here. Here it is. No, I just saw it. There it is, forward rate of return right there. Sorry about that. So here's the Yachtman forward rate of return. And then here's the Peter Lynch value. There's the Graham number right below it. It's even got that median price to sales, the projected free cash flow, the net current asset value. All these we looked at. And the reason I point this out and the reason I think it's interesting is you can get an idea of where these have been historically. So in addition to just seeing a traditional stock chart, you can see, all right, let's see how this Peter Lynch value's looked. We can click on it, and all of a sudden we've got an annual chart of that Peter Lynch value and a quarterly chart over here to the right. Now, what it also does, you probably noticed with that blue line, let me zoom in on this just a little bit for you guys. Whoops. Is it's automatically projecting a growth trend line. It's done a quick calculation, and this blue line you're seeing right here, I'm saying on average they're growing in the last 5 years about 28.9%. So that's the trend line. You see it kind of exceeded it, fell behind it, but you kind of get a quick idea. So it's just nice, right? Generally, more people are visually inclined versus data inclined, meaning most people prefer to see it in a chart format or some kind of visual dictation versus just staring at all these numbers. Maybe you're not, but it's just a nice to have the option to do that. And just so you know, this works on any metric here. Okay, even the month-end stock price, you can chart that out. You can look at the median price to sales, share price, where that would have been. It's nice to kind of visualize those out. Now, one final thing I want to look at that we can take questions. And that is forward earnings. Okay, now we get a lot of questions on this. Is value people or traditional value investors, this is generally their weakness, and that's forecasting the future, right? Because we're not buying a stock for what they did last year. We're buying a stock in expectation of what it's going to do next year and the year after and the 2 decades in front of us, okay? So Wall Street in general, and if you go, sit on the desk at J.P. Morgan, you go sit on the desk at Bank of America, and you listen to their kind of war room talks, they're talking in forward multiples. We're talking, what is this company going to earn next year? What is the forward PE, or what multiple is next year's earnings at today's share price? And again, as I mentioned, traditional value analysts focus on earnings and assets today. The institutional money, what they're doing is trying to predict where the numbers will be in the future based on their analyst expectations. Okay, so they don't care the stock made $10 a share this year. They want to know, what are they going to make in 2016, in 2017? What is that going to calculate to in terms of price? If that means it's going to be worth 150 a share, we can buy it today for 100. That's probably a good buy. So what Guru Focus has done as a new feature inside the last year is they now include these analyst expectations inside of the interactive charts. And we're going to look at that and show you how valuable this can be to you. Now, a quick note, the forward expectations are only available for widely covered stocks. It's not because we're being picky and choosy. It's just because if you've got, a $50 million small cap company, Goldman isn't sending their analysts over to keep an eye on it, right? They don't care what it's doing. It's too small. It's not even a blip on their radar. They can't invest in it. So there's just no analyst following it. You look at Apple, there's plenty of analyst attention on that. We've got a lot of opinions, a lot of predictions and expectations that we can produce a normalized figure of what the street is expecting going forward. So let's go take a look at that, and we'll look at Apple now. What we're going to do is go to the interactive chart right across the top there. Sorry, I was trying to get my pen out. Right here, the interactive chart. This is active for any stock. Or you can put in the ticker symbol up here, and you'll see a drop down for interactive chart. I'll show you that as well. There's a couple of ways to find this. So if you kicked in the ticker symbol, you see right here, you've got interactive chart as one of your options. Or you can simply click here on the interactive chart heading to get to this. And by default, it's going to show us a stock, stock chart, just time and price. This one goes all the way back to 1990. So find somewhere else you're getting, what is that, 25 years of data, which is a lot. And what we can do is anything that's relating to earnings is going to include the analyst expectations and the forward estimates. So this is PE ratio. And as of today, it's got a PE based on, this last quarter's earnings. It's got a PE ratio of around 15.7. Pretty fair, in my opinion, for a rock star like Apple. And based on what analysts think they're going to earn going forward, out to June 2018, today's price would be a PE of 11 then. Now, this is a little bit tougher to see, right? So it's a better way to do it. Here's what I like to use. Find out what the average multiple of the stock is. Okay, they a 10 times earnings company, they a 20 times earnings company. We'll use 15 since it's kind of a standard benchmark fair price. And what we've got now is, and I'll just skim this down to 10 years, also known as the Peter Lynch chart. We've got the price of the stock in green, just a historical, regular stock price chart. And then in blue, this is a hypothetical price of what the stock will be trading at 15 times its last 12 months of earnings. Okay, and if you look at Apple, it's followed the stock pretty well, right? I mean, if we're looking all the way back, we can go back even further. I'm looking at 10 years. Let's go. It's a little bit far. I don't look all the way to 1990. Let's go maybe back to the year 2000. And this is a fantastic stock. As we all know, it's made many, many, many millionaires. But if we use this line and think, okay, I want to bet when it's around 15 times earnings, look, it got a little bit hot in here. Okay, went a little inflated, and you can say the same in this area. And the stock went from $25 a share down to about 13. So you took a 50% hit. Now, you've made many times that by now if you held it. But if we're looking at ideal times to buy this stock, around 15 times earnings is pretty good spots, right? A little undervalued here, pretty close, but a little overvalued here. Huge buying opportunity. This was back when the stock got down to like 395, 400 before the split. And then now we're just barely on the high side of that earnings line. But I'm not trying to tell you when to buy Apple stock. The point of this is to say, based on this and based on where they think earnings are going to be the next several years going forward, that's where it would put the price, is around 165 in 2018. So if you figure, all right, that's a 2-year hold, 2.5-year hold to take it from roughly 125 to 165. What does that calculate out to, and is that worth my time? Is that a high enough reward for me to take this investment? So you can look at other stocks as well. Now, Apple goes out to 2018. Not all stocks have estimates going that far forward. If we change this over to Walmart, for example, and you can change it right in here. You can just hit the switch ticker box, WMT, and hit go. And it'll give you the exact same chart for your new stock. So this is Walmart, and we see the analyst expectations for Walmart go out to September of 17, so about 2.5 years. A little, not quite as far, but we see there's probably a reason that Apple stock excuse me, that the Walmart stock has recently pegged from, high 80s down here to about $80 a share. And the reason is these estimates are low for the upcoming year. So if I'm looking at this stock now, I think it's a pretty slow grower. It stays at about 15 times earnings these days. Doesn't look like it's going to grow a whole lot. Maybe not an ideal investment for me right now. If I'm looking for a substantial return, if I'm looking for a hedge, if I'm looking for, just a safe place to put capital into a quality company, maybe it fits your bill. And yeah, Michael's got a good point. He says, yeah, assuming no major market corrections in the interim that could delay the forecast. It's absolutely true. And look, don't take any of this for heart, right? These guys are not giving you an ironclad guarantee that says, I promise you, Apple's going to make $17 a share in 2017 or I'll quit my job. No, it's an estimate. And it's the average of all of the top analysts that follow this company. One may say they think they're going to do $19 a share, one says 21, one says 25. They average all those and give an example and give an average, of what those top analysts are expecting. So as far as trying to predict, I think these guys are a little bit more qualified than the average investor. It's good information. Are they always right? Absolutely not. But these are, the best kind of, essentially the closest thing we had to a crystal ball on earnings. But in my opinion, it's a really interesting way to look at forward earnings, and this can really help you out a lot, especially just a visualization of it. You can look at, it's only the earnings they really forecasting going forward. They're not trying to forecast what the book value is going to be, what the sales figures are. Generally, it's just what they think they're going to earn. And you could do this generally for any very large stock that's going to be heavily followed. Here's General Electric. We see their forecasts go out. They only go out a couple quarters for General Electric. It's not because we didn't do a good enough job. That's all the analysts are producing right now. If we go to look at like a Disney, we're getting a little bit further out to September 2016. That's about 18 months into the future. But that's a really nice way, I think, to use that going forward. You don't have to do it at 15 times earnings. I mean, look at a stock like Disney, for example. Here's an easy way to do it. We'll look at their PE ratio. And let's just focus on the last decade, right? So it looks like it's been their PE ratio generally is between, and really I'm going to take out this blip in 04. Yeah, we'll start here in 04. So generally between about 28, and here on the low side in 2009, got to about 10 times earnings. So between 10 and 20, so what's that mean? Well, the average PE on this thing's probably 19, 20 times earnings. Okay, just going to give you where the meat of this is, right about 20. So we figured Disney's a top caliber company. They're probably worth 20 times earnings, at least it's where they normally trade. Then we just go over here. We want to see the price at 20 times earnings, overlaid with the current stock price. In the last 10 years, we can declutter this chart. Want to see accurate quarterly data. And that's what we get. And that's a little bit of a better looking chart, right? It's pretty close to what this thing is following if we're just looking at earnings, right? It got a little hot here, a little light here below, in the 08-09 recession. It's a pretty good buying opportunity here, late 12. It's getting a little bit inflated right now based on expectations we have going forward. So to me, if the stock generally trades about 20 times earnings, fast forward a year and a half, it's going to be about $1.12 a share. Yet this stock is already trading at $1.10 a share. To me, it's not a huge opportunity going forward, just based on analyst expectations, what we can see going forward, right? Now, if the stock were trading at a fair price today around here, or even undervalued based on its historic earnings multiples, well, then I've got an opportunity. If I got an opportunity to buy this at 75 and it's going to 112, ballpark in the next couple of years, that's a much more substantial move and in my opinion, worth more risk and worth an allocation of capital. Now, Michael's got a question. He says, does price usually revert to the mean of the PE? And Michael, as a general rule of thumb, I would say yes, especially for these large blue chip Dow caliber, staple industries. Pretty much any stock, you can produce a chart similar to this that you can kind of see. And look, this is the most elementary way to invest, but it's one of the easiest. I'll show you the one chart of why I bought Apple. I think we already looked at that. It's just very simple. I mean, a lot of analysts were writing the stock off. This is at 15 times earnings. And I mean, if we get it even higher, which I think it's worth more, but even if we get it higher, it'd be even bigger. But, it's not real tough. I mean, this thing should be worth, 80, 90 bucks a share. It's trading down here at 55, 60. Pretty easy to see. But yes, generally stocks will return to their mean, right? I mean, if it's a stock that's long time been a 10 times earnings company, a 20 times earnings company, and they're up here at 50 or 60 times, earnings, unless there is a forecast that those earnings are going to grow immensely, yes, it will almost always revert to its mean average there. Yeah, so someone asked about international stocks. It's absolutely all of these features work exactly the same on European stocks, on Asian stocks, anything you have a data package to here with Guru Focus. So for instance, if we looked at one person asked for ABF, and I know what this company is. I should have global. Here we go. So Smiley, this is an Australian company, ABF, someone mentioned here. You're getting all the exact same data. Go back, look at the same Peter Lynch chart. Now this one's a bankrupted company. Does anyone have one that's currently still traded? You got a foreign stock? Let's look at BMW. We can go to the interactive chart. I'm using the Peter Lynch chart from the drop down. And we're seeing much of the same stuff. Now, we don't have forward expectations on this one, but we can use all the exact same chart features on all the same valuation metrics in here. And they're also in the local currency, which is nice, right? You see this, you can see at the top there, doesn't convert everything to US dollars and make you kind of adjust all of those. So Johnny asked a question. He said, what are the guru's opinions on whether or not to add the tangible book value to discount cash flow? I would say it's kind of 50-50. I mean, if you get to a situation where you need it to justify your valuation, probably not a great choice. We've been using Apple. I just think it's easy to stay with the same stock. Let's go back to the discount cash flow calculator. I wanted to cover this really quickly. Now notice it's got 20% in here. Okay, hopefully you guys can see this. By default, it's using a 20% growth rate for the next 10 years, giving us a huge fair value of 230 bucks a share. Now, I think that is extensive. It's going to make it a $1.5 trillion company. But we can find out where this is coming from, right? So we hover over this question mark. We see the number of years in the growth stage, the average growth rate. We'll see where this number comes from. If you scroll down just slightly, it will give you all of the growth rates. We find out all these for you. You don't have to dig into them. All of them are right here. That's revenue growth rate, EBITDA, earnings, free cash flow, book over the last 10 years, 5 years, 12 months. etc. Now, these are extensive. Apple's been a phenom story. So we want to take a conservative approach to these and kind of put together an estimate we think is reasonable. Do we think they continue to grow at 20% a year? I don't know. I mean, maybe you think they're only going to grow at 10% a year. If that's the case, then they're overvalued. But your discount rate's extensive. Interest rates are extremely low, so I'd be using closer to a 9% discount rate today if it were me, and you go with the higher fair value. It's all about, again, like I said, garbage in, garbage out. And then once again, as I mentioned, if you check the add to fair value box as we did just here, it adds this $20 into your price. And it also breaks these two up, which I think is nice, right? It shows you the growth value, meaning the next 10 years, and the years 11 through 20, what those two are worth to you. So you can kind of see where the majority of that's coming from. Now, someone also asked, and it's good that you see this on here, there is a reverse discount cash flow. It's a relatively new feature. It's been here less than 2 years. And this is really cool as well. So if you're kind of confused, I wouldn't say confused, but if you're kind of back and forth on what you think the growth rate is, I don't know what do you really think they can do. What the reverse discount cash flow does is give you a projected growth rate that it would need to make in order to justify today's prices. Okay, so we click on that, and here's the growth rate, 4.39%. So if you think they're going to grow in excess of 4.39%, then it's likely you'll make money with this. Now notice when we took this off, right? This is for $175 valuation. It would only need to grow this. At $154 valuation, it would need to grow at 7%. So it's just a nice way to say, okay, well, this is roughly what I think it's worth. What would it need to grow? And it kind of gives you a number there. And if you think it can beat that, it's probably a good buy. If not, then it's not. Now, in addition, it does have a margin of safety. Someone asked how that is calculated. Extremely, extremely simply. The margin of safety right here, I hope you can see this. Let me zoom in a bit. This margin of safety figure is simply today's price versus what you've calculated for a fair value. Apple's trading, I don't know what it is, somewhere around 121, something like that today. So it is 18% below this price. So in other words, if you're trying to buy it based on what it's worth to you today, that's how much wiggle room you have. You're protected. You want a high margin of safety. If, on the other hand, we were to say, oh, it's not going to grow very fast, and we get a low value, notice how margin of safety becomes negative if the projected fair value is less than today's share price. Okay, so that's kind of how that works. But I would encourage you to play with this DCF calculator. The discount cash flow, as mentioned, is probably the most popular valuation method that I have seen, other than just basic earnings multiples going forward earnings. Again, the street follows earnings, right? We try to take a more complete look at a stock, judge their book value, judge their sales, make sure they're not overly leveraged and debt laden, which is why we do some of these more intensive calculations. But earnings essentially will move a stock. So looking at where we think they're going to be, what predictions there are for future earnings, and where that price ties or stands today in relation to that projected future value is going to be of great value to you. So hopefully this has explained the majority of these traditional valuation methods. I hope you got something out of this. Again, this video will be uploaded to YouTube at the conclusion of this presentation probably by tomorrow morning. So feel free to come back, check this out, review any parts you wanted to see again. We definitely appreciate all of you joining us today. If you have any questions, please feel free to email us directly at support@gurufocus.com, and we will get back to you as quickly as possible. Thank you all for